All right, what's going on, everybody? We got FOMC coming out here in 2 minutes. We pretty much know what's going to happen. They're going to rate hike us about 25 basis points, and then we're going to hear what they got to say. I've had an interesting day on Bitcoin already. If you don't think the gap was filled on this day because $35 was 35 bucks, but some people still didn't think $35 was enough to consider the gap filled. It's definitely filled now. There is no doubt about it. You've had a pullback of a decent size here, and within 2 minutes to actually getting the rate decision or the dot plot matrix, you can see you are getting a little bit of aggression here. There it is right there. We're sitting at 4.75. 5 is expected. So it's a quarter of a point. We're looking for a potential resistance at 28,990. So, I mean, if we were looking for bullish continuation, what we'd want to see is a spike lower, take out the low of day, and then we'd want to get long, as long as it's not more than 25 basis points. If this number comes out at 5.25, then you would not be looking to buy it. We think the market's already priced in the rate hike. We think the press conference is going to be more important, and vice versa. If you get a spike up to there, we'd be looking to sell it. $28,990, and we'll go over why here in a minute. There it is. There it is. There it is. So you're getting that bullish reaction, bearish reaction on the dollar. We didn't get to the level we wanted, though. But we could get up there during the speech. You just traded right into a weekly level. Right there. All right, so we're coming back down. Be nice if we make a low of day, because trading in the middle of the range gives us nothing. I guess one could have bought support right there, but there's not much support there to buy. Yeah, we were expecting volatility. We got it. That's why you don't take positions before today. I mean, this was your breakout candle. You can see that you completely annihilated both sides of the breakout candle. This is late data over here, so don't worry about it. Basically with everything that I see on the charts, guys, you don't want to be a seller. You're making obvious higher highs, higher highs, higher highs. It's a wedge formation, but retail patterns do not typically work out. But we'll get an opportunity wherever price is during the press conference. We'll look for entries then. His first initial move is just to basically throw everybody off. Yeah. Pretty much what we figured. It's pretty much what we were expecting. But I would have loved to have seen it get up there to that, at least get up to this resistance level to give us a reason to look for short entries. I mean, that was close, but dollar's still getting crushed. We're going to pull up the dollar daily and you're going to see that. Oh, look at that. Trade talk was right again. We're trading back under the yearly opening range, like I expected. This is a risk on market, ladies and gentlemen. Just look at tech. Bitcoin and tech are trading pretty much hand in hand. S&P 500 making a move higher. I am looking for a short here as long as it doesn't continue through it. Low leverage, small position. All right, let's see if we can get another spike up into it. And we'll go ahead and take it. Because if I ain't mistaken, what did I say in the Discord? 29,385. Yeah, it did not get up to it. It might tag it when we actually get the announcement. When he starts speaking, you might get another stab up in there to liquidate whoever got short on this wick and then whoever got short on that wick. Because they're not going to play around, especially if they're using a lot of leverage. Their stops are going to be very close. And they're not even going to have a reason to be putting stops up here generally. Right? Like you're probably, if you're in the Discord, you know why. There's why this is the area we were looking to sell, right? If you're not, you're going to be like, why? Because you're going to be looking on your chart and you're going to be like, that ain't nothing. There's nothing there. It's in the middle of nowhere. But there's a specific reason. We got 20 minutes left on that speech. Dollar came down, liquidated those swing lows right there. So if it does get bearish and the dollar does ultimately get bullish, then any pullbacks into this, we're going to be watching for those short positions as we are looking for bullish continuation. But for the day trade, we're looking for whatever it gives us. Thank you for sharing on all the platforms, Ray. I appreciate it. No, I've lost my voice. I have no idea what's happened to it. It's been like this for a couple weeks. It makes me sound drunk. Will in the chat say, make your mind up. Dude, that's what volatility is. This is what volatility is. It's to liquidate everybody, both sides. It's not trying to give you the ultimate entry. It doesn't want you to succeed. So the problem that it has is we're market snipers up in this. Son of a gun. Yeah. Would have been nice to catch the wick, but it's that or nothing. That's an old monthly resistance level. That's all it is. Right? Because this monthly candle is already so damn stretched out. I mean, obviously it can go higher. But I was trying to get it lined up with the CME monthly. Right there. Right? Because that was an epic gap. So I figured we could tag that and then get our pullback, and then we can look for our support entry later on down the road, like in the next month or two. So if we miss the short because it didn't go all the way there, I mean, big deal. We'll catch it tomorrow. If it wants to be a short. A low a day, as long as it's not giving us gigantic continuation, I'd probably be okay to buy it during the speech, as long as he doesn't come out and say something uber hawkish, which he will more than likely, because that's what they do. Kudos on anybody that was able to jump into that. You definitely want to take profits. It's almost a 2% move. So I mean, just a small amount of leverage on that trade, and you're looking at a pretty damn big gain. We got 15 minutes until the press conference. So this is an old intraday resistance. Let's go see if it's daily res. The open. There's the open. Yeah, definitely not making it easy. And he hasn't even began to speak yet, so typically, I mean, what we've been seeing lately is the first initial move usually gets faded. So wherever price is trading at the press conference, we're more or less going to be looking to fade that. That's good enough. We don't need the exact spot because it's a choppy day, right? Always is. Always is. You get your open and price sets a high, sets a low, and then chops around. All in all, I think you move 2% on the day. That's not a big move at all, considering we just seen Bitcoin make an 8% move on zero news the other day. On zero news. There's your low of day. Point of control setting pretty much right in the middle of the range. Little bit near the bottom side. So that is still set up for buyers. All right. And now we're just waiting. Yeah. What's up, Trade Talkers? What's up, Aaron C? Greetings. Edom, hit the like, share all your platforms. Thank you so much for that, Ray. This might sound out there nuts, and I don't take it too seriously myself, but Goldman calling for a pause. Nah, they might pause like on the next hike, the next cycle, but they had to do it today. They were looking to break some eggs. You can't make an omelet without breaking some eggs. They were looking for something to break. The banks were the thing that broke. That's for sure. They didn't know for sure what would break, but you got a lot of people out there that are very in the banking world that are very upset because technically they didn't do anything wrong. They had their money on long duration rates. So this rapid rise in interest rates crushed them, which in normal conditions would be okay because those rates pay out no matter what. But what happened was people started to take their money out. That's what happened. And now there's a contagion where everybody thinks they need to run out there and take their money out of the bank because they do not understand how a bank works. And as far as Bitcoin going up based on the banks, I don't think that's why Bitcoin's going up at all. I think Bitcoin is following tech. There's your tech chart right there with Bitcoin. I mean, they look freaking similar. Not identical, but similar. Year to date. Year to date. That's the XLK, the sector that tracks tech. And then, of course, if I make this over here big and show you the ETF for the tech sector and the options expected move for this week. And trust me, they priced in this move. You can see right there. So the XLK pushing up today on the news all the way up to the upper band of the option weekly expected move. We had a technical level up here that we were watching for the pullback from. It just didn't hit it. We got 5 minutes. This is the open of the day, so it's going to be yesterday's close also, which is, a resistance level, potential resistance. We'll see if old resistance wants to act as support. And then you got intraday resistance right above it at 28,301-ish. I guess that's live no matter what, right? Yes, happens. Yeah, tomorrow. No, I will not be up at 4:30 in the morning. We're just looking for a pullback into any kind of major resistance. You're going to expect volatility the same. I mean, yesterday it's already given us quite a bit of volatility. We had this run above resistance, close above, then trap, boom. So, I mean, the perfect entry would have been up there, expecting that move. So you got two levels you can watch for potential entries. But the thing is you got to be careful for spikes higher, because you're going to get the same thing. And that's just on the Aussie one. On the Canadian dollar side, same thing. Push up, broke above resistance, set in bull trap taken out. Today gave you a flawless entry. Just had you been watching that right there. Not a perfect entry, but so watch for a run above that tomorrow. That's a swing high. And then look for entries close to that. If you start closing hourlies above that, then obviously something is different. Something has changed. You don't do anything. I don't suspect you will, but it doesn't mean anything because I'm not ever trying to dictate price direction. I'm only looking for high probable entries. Whether they get stopped out or not is irrelevant. It's about being consistent over time. That's what makes you profitable. The strategy remains the same as always. Always, always. We're looking for the same stuff over and over and over again. That would have been a beautiful entry. But you also got to keep in mind that you're drifting further and further away from this. So at some point, you can expect a pullback to it. So, I mean, there is no rush on the entry. There's no rush. We get the news and then the market's reaction to the news. Bitcoin's going to play this game where it's going to be right in the middle of the freaking zone.
Good afternoon. Before discussing today's meeting, let me briefly address recent developments in the banking sector. In the past 2 weeks, serious difficulties at a small number of banks have emerged. History has shown that isolated banking problems, if left unaddressed, can undermine confidence in healthy banks and threaten the ability of the banking system as a whole to play its vital role in supporting the savings and credit needs of households and businesses. That is why, in response to these events, the Federal Reserve, working with the Treasury Department and the FDIC, took decisive actions to protect the U.S. economy and to strengthen public confidence in our banking system. These actions demonstrate that all depositors' savings and the banking system are safe. With the support of the Treasury, the Federal Reserve Board created the Bank Term Funding Program to ensure that banks that hold safe and liquid assets can, if needed, borrow reserves against those assets at par. This program, along with our long-standing discount window, is effectively meeting the unusual funding needs that some banks have faced and makes clear that ample liquidity in the system is available. Our banking system is sound and resilient with strong capital and liquidity.
I don't like taking a
We will
short
continue
here
to
with this
closely
big
monitor
wick,
conditions in the
guys.
banking system and are prepared to use all of our tools as needed to keep it safe and sound. In addition, we are committed to learning the lessons from this episode and to work to prevent events like this from happening again. Turning to the broader economy and monetary policy. Inflation remains too high and the labor market continues to be
outer
very tight.
bounds.
My colleagues and I understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. The U.S. economy slowed significantly last year, with real GDP rising at a below-trend pace of 0.9%. Consumer spending appears to have picked up this quarter, although some of that strength may reflect the effects of swings in the weather across the turn of the year. In contrast, activity in the housing sector remains weak, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. Committee participants generally expect subdued growth to continue. As shown in our summary of economic projections, the median projection for real GDP growth stands at just 0.4% this year and 1.2% next year, well below the median estimate of the longer-run normal growth rate. And nearly all participants see the risks to GDP growth as weighted to the downside. Yet the labor market remains extremely tight. Job gains have picked up in recent months, with employment rising by an average of 351,000 jobs per month over the last 3 months. The unemployment rate remained low in February at 3.6%. The labor force participation rate has edged up in recent months, and wage growth has shown some signs of easing. However, with job vacancies still very high, labor demand substantially exceeds the supply of available workers. FOMC participants expect supply and demand conditions in the labor market to come into better balance over time, easing upward pressures on wages and prices. The median unemployment rate projection in the SEP rises to 4.5% at the end of this year and 4.6% at the end of next year. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in January, total PCE prices rose 5.4%, excluding the volatile food and energy categories. Excluding those, core PCE prices rose 4.7%. In February, the 12-month change in the CPI came in at 6%, and the change in the core CPI was 5.5%. Inflation has moderated somewhat since the middle of last year, but the strength of these recent readings indicates that inflation pressures continue to run high. The median projection in the SEP for total PCE inflation is 3.3% for this year, 2.5% next year, and 2.5% in 2025. The process of getting inflation back down to 2% has a long way to go and is likely to be bumpy. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets.
That's your low day right there.
The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people.
Perfect.
My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials, like food,
big bearish pushes from down in here, like
we are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective.
As this adjusts
At today's meeting, the
itself,
committee raised the target range for the federal funds rate by 1/4 percentage point, bringing the target range to 4.75% to 5%.
Yesterday's low is all the way down there,
and we
so
are continuing the
start
process
making a
of
push for that,
significantly
then
reducing our securities holdings.
we're wrong.
Since our previous FOMC meeting, economic indicators have generally come in stronger than expected, demonstrating greater momentum in economic activity and inflation. We believe, however, that events in the banking system over the past 2 weeks are likely to result in tighter credit conditions for households and businesses, which would in turn affect economic outcomes. It is too soon to determine the extent of these effects, and therefore too soon to tell how monetary policy should respond. As a result, we no longer state that we anticipate that ongoing rate increases will be appropriate to quell inflation. Instead, we now anticipate that some additional policy firming may be appropriate. We will closely monitor incoming data and carefully assess the actual and expected effects of tighter credit conditions on economic activity, the labor market, and inflation. And our policy decisions will reflect that assessment. In our SEP, each FOMC participant wrote down an appropriate path for the federal funds rate based on what that participant judges to be the most likely scenario going forward. If the economy
If it takes
evolves
out the
as
low day
projected,
again,
the
I'm
median
beast
participant
out now.
projects that the appropriate level of the federal funds rate will be 5.1% at the end of this year, 4.3% at the end of 2024,
Target
and 3.1% at the end of
resistance
2025.
28719.
These are little changed from our December projections, reflecting offsetting factors. These projections are not a committee decision or plan. If the economy does not evolve as projected, the path for policy will adjust as appropriate to foster our maximum employment and price stability goals. We will continue to make our decisions, meeting by meeting, based on the totality of the incoming data and their implications for the outlook for economic activity and inflation. We remain committed to bringing inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening in labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Thank you. Colby Smith with the Financial Times. How confident is the committee that the recent stress that we've seen and you've alluded to is contained at this point, and that deposit flight among mid-sized lenders in particular has ceased?
Thanks. So I guess our view is that the banking system is sound and it's resilient. It's got strong capital and liquidity. We took powerful actions with Treasury and the FDIC, which demonstrate that all depositors' savings are safe and that the banking system is safe. Deposit flows in the banking system have stabilized over the last week. And the last thing I'll say is that we're undertaking a thorough internal review that will identify where we can strengthen supervision and regulation.
Okay, just a quick follow-up. I mean, given all of the stress and the uncertainty that you've also alluded to in the statement, how seriously was a pause considered for this meeting?
So we did consider that in the days running up to the meeting, and you see the decision that we made, which I'll say a couple things about. First, it was supported by a very strong consensus, and I'll be happy to explain why. And really it is that the intermeeting data on inflation and the labor market came in stronger than expected, and really before the recent events, we were clearly on track to continue with ongoing rate hikes. In fact, as of a couple of weeks ago, it looked like we'd need to raise rates over the course of the year, more than we'd expected at the time of the SCP in December, the time of the December meeting. We are committed to restoring price stability, and all of the evidence says that the public has confidence that we will do so, that we'll bring inflation down to 2% over time. It is important that we sustain that confidence with our actions as well as our words. So we also assess, as I mentioned, that the events of the last 2 weeks are likely to result in some tightening of credit conditions for households and businesses, and thereby weigh on demand, on the labor market, and on inflation. Such a tightening in financial conditions would work in the same direction as rate tightening. In principle, as a matter of fact, you can think of it as being the equivalent of a rate hike, or perhaps more than that. Of course, it's not possible to make that assessment today with any precision whatsoever. So our decision was to move ahead with a 25 basis point hike and to change our guidance, as I mentioned, from ongoing hikes to some additional hikes some policy firming may be appropriate. So going forward, as I mentioned, in assessing the need for further hikes, we'll be focused, as always, on the incoming data and the evolving outlook, and in particular on our assessment of the actual and expected effects of credit tightening.
So basically, if more banks start falling, then he'll
Mr. Chairman,
probably
can you explain
hold up
the difference between ongoing
on
rate
any
increases
more
and
rate
firming? Does firming imply
They're
a
gonna
rate
ask
increase
that
per se,
question
or
30
could
times
policy firm without you
today.
increasing rates?
No, I think it's meant to refer to our policy rate. Really, I would focus on the words may and some, as opposed to ongoing. So we clearly what we were doing there was taking on board trying to reflect the uncertainty about what will happen. I mean, it's possible that this will turn out to have very modest effects. These events will turn out to be very, very modest effects on the economy, in which case, and inflation will continue to be strong, in which case, the path will might look different. It's also possible that this potential tightening will contribute significant tightening in credit conditions over time, and in principle, if that means that monetary policy may have less work to do. We simply don't know. So.
Do you have concerns that the hike you did today could further exacerbate the problem in the banks?
No, I mean, with our monetary policy, we're really focused on macroeconomic outcomes. In particular, we're focused on this potential credit tightening and what can that produce in the way of tighter credit conditions. I think when we think about the situation in the banks, we're focused on our financial stability tools, in particular, our lending facilities, the discount window, and also the new facility.
Nick?
So my entry's at a 1 to 1.
Nick Timmeros,
I'm
Wall
gonna
Street
go ahead
Journal.
and take a little
Chair
bit
Powell,
of
in your
profit
testimony
off of
2
here
weeks
because
ago,
I'm
you
not
had indicated
seeing
you
that
thought the
big
terminal
bounce
rate
that I
would be
wanted to
higher.
see.
Obviously, that was before the stress in the banking sector. And I realize there's a lot of uncertainty, but can you explain at all to what extent
Just to get
your
some of the
forecasts
risk
or those
off
of
the
your colleagues
table.
or those of the board staff incorporated today a material tightening of credit availability because of the stress in the banking sector, or are you waiting to see it in the data before you incorporate that potential tightening into your forecasts?
So, we've just come from an FOMC meeting, and, the people who write the minutes will be very carefully counting. But I'll tell you what I heard. What I heard was a significant number of people saying that they anticipated there would be some tightening of credit conditions, and that would really have the same effects as our policies do, and that therefore they were including that in their assessment, and that if that turned out not to be the case, that in principle you'd need more rate hikes. So some people did reflect that in their SEP forecasts. I think there may also just have been, remember, this is 12 days ago. We're trying to assess something that just is so recent, and it's very difficult. There's so much uncertainty. So December was a good place to start, and we wound up with very similar outcomes for December. And in a way, the data in the first 5 weeks of the intermeeting period, pointed to stronger inflation and a stronger labor market. So that pointed to higher rates, and then this
My
latter part,
entry's roughly
the
right in
possibility
there.
of credit
I got a
conditions
pretty
tightening
bad
really
fill on
offset
that.
that effectively.
To follow up, have you considered at all whether your primary tool, the funds rate, is
But
going
you
to be
can
enough
see
to sustain the
if my
kind of tighter
entry
financial
is
conditions that
here,
you believe will be necessary without
this is my
doing
profit target.
significant
I mean,
damage
I'm
to the banking
freaking
sector? Have you,
almost
for example,
there.
considered changing reserve
So as
requirements,
far as I'm
selling assets out of the
concerned,
system open market account
taking
as a
profits
way to better achieve
now and
tighter
moving
financial
my stop
conditions
loss
that don't
is a good
accelerate
way to
deposit
mitigate
erosion,
that
for example,
risk.
from banks?
Because I don't know what's
we know that
going
we have
to happen.
other tools in effect,
I
but now we
never
think
know
our
what's
monetary
going to
policy tool
happen.
works, and we think
It just looks
many banks
like I do.
Our rate hikes were well telegraphed to the market, and many banks have managed to handle them.
Victoria.
Hi, Victoria Guido with Politico. I wanted to ask,
Here's
you,
your
along with the
indices right
FDIC
here,
and the Treasury,
all
the
three
Fed
of your
Board decided
majors.
to invoke the systemic risk exception to allow uninsured depositors to be protected at these two banks. And I was just wondering if you could speak to why that decision was made. Was it purely a confidence issue, or was there a concern that there would be some sort of economic contagion or financial contagion from the failure of these banks?
The issue was really not about those specific banks, but about the risk of a contagion to other banks and to the financial markets more broadly. That was the issue.
Okay, and then can you also, just to follow up, can you speak to the role that you will be playing in the Fed's
Dollar
internal
is
investigation
on the
its
freaking
supervision and regulation?
lows still.
Vice Chair Barr is of course leading that review, and he's responsible for it in his capacity as Vice Chair for Supervision. I realized, right away that there was going to be a need for a review. I mean, the question we were all asking ourselves over that first weekend was, how did this happen?
ROE
And,
is currently
so,
sitting at 38%.
What we did was
so
early Monday morning
I'm
we
good
sat
with
down and
that.
said, let's do this, and he was obviously
Taking
going to lead
the
it in
rest
his
off,
capacity.
moving my
I don't,
stop to break
my
even.
my role was to announce it, and I get briefed on it, but I'm not involved in the work of it.
That was with 25x leverage.
Hi, Chair Powell, Howard Schneider from Reuters. So I want to go back to your February press conference. You mentioned the word disinflation, I believe, 9
We'll
or
let
10
the
times
rest run,
process that
see
you
what
thought was,
happens.
I forget the word you used, but gratefully underway or something like that. Is disinflation still occurring in the U.S. today?
Yes, I mean, what actually happened, Howard, was I got the question 12 times. So maybe it's a feature, not a bug. But yeah, absolutely absolutely the same. The story is intact. So it's really three parts, right? Goods inflation's been coming down now for 6 months. It's proceeding more slowly than we would have liked, but it's certainly proceeding. Housing services is really a matter of time passing. We continue to see the new leases being signed at much lower levels of inflation. So that's 44% of the core PCE index, where you've got a story that's ongoing. Where we didn't have in February and we still don't have now is a sign of progress in the non-housing services sector, and that is that's just something that will have to come through softening demand and perhaps some softening in labor market conditions. We don't see that yet, and that's of course 56% of the index. So the story is pretty much the same. I will say that the inflation data that we got, to your point, really pointed to stronger inflation.
If I could follow up on that, I was curious why you don't see more coming from the
2, 8,
credit crunch, because it seems to me that's something that you'd actually welcome to a degree and expect. And are you not seeing more coming from that because you don't know, or because you just don't want to have another round of wishful thinking?
So it's really just a question of not knowing at this point. There's a great deal of literature on the connection between tighter credit conditions, economic activity, hiring, and inflation. Very large body
That's
of
the
literature.
profit target.
The question is, how significant will this credit tightening be, and how sustained will it be? That's the issue, and we don't really see it yet. It's so people are making estimates. People are publishing estimates, and it's very kind of rule of thumb guesswork almost at this point. But we think it's potentially quite real, and that argues for being alert as we go forward, as we think about further rate hikes. For us, we'll be paying attention to the actual and expected effects from that.
Gina?
Hi, Chair Powell. Gina Smilek from the New York Times. Thank you for taking our questions. I wonder if you could talk a little bit, I know that you've got your internal review coming, but I wonder if you could talk a little bit about what you think happened with oversight at Silicon Valley Bank, and whether this suggests that something about regulation and supervision needs to actually change going forward. And I wonder, how can the American people have confidence that there aren't other weaknesses out there in the banking system, given that this one got missed, as you noted?
So let me say what I think happened, and then I'll come to the questions around supervision. So at a basic level, Silicon Valley
didn't
Bank
know, T.
management
that I wouldn't
failed
be
badly.
stopped out, dude.
They grew the bank very quickly. They exposed the bank to significant
understand
liquidity
how
risk and
much
interest rate risk. Didn't hedge
that I
risk.
was risking.
We now know that supervisors saw
I
these
trade
risks
for a living,
and
so I'm
intervened.
sitting right here.
We know that
so it's
the public
not going to
saw
get
all
too
this.
out of control. I pretty much.
We know that
I've
SVB
been doing this
experienced
for a
an
very long
unprecedentedly
time,
rapid and
is
massive
all.
bank run. So this is
That's
a
what I
very
was
large group
looking
of
for
connected
it to
depositors,
do.
concentrated group of connected
You will
depositors.
essentially
in a very, very
always get a
fast run,
stab
faster
lower,
than
and then
historical
another
record
push
would
even
suggest.
lower.
So
So you are correct. It
as
did,
for
in
us,
fact,
so
make a lower
for our
low
part,
after my
we're doing a
position
review
was
of
entered.
supervision and regulation.
Had I had the stop
My
loss
only
up,
interest
I would have
is
been
that we
stopped out.
identify what went wrong here. How did this happen? Is the question.
But I'm
what went
looking
wrong?
at
Try to
where
find
I'm
that. We will find
entered,
that, and then make an
and I
assessment
know
of what
at
are the right
which
policies
price
to put in
it
place
gets
so that it
to
doesn't
that I
happen again,
want to
and then
get
implement those
out
policies.
no matter what.
It would be
and then I would
inappropriate
just
for me at this
cancel.
stage to offer my views on what the answers might be.
Close
I
all
simply can't do that.
positions.
Vice Chair Barr is leading this, and I think he's testifying next week. So, but that will be up to him.
It's a very
So
risky
that's really
strategy,
where it is.
man.
You're
trading
The review is going to be thorough and transparent.
the most volatile
it is clear to your
of
really to
price
your last
action.
question. It's clear that we do need to
I'm
strengthen
just
supervision
showing
and
you that
regulation.
it's possible.
And I assume
how
that,
to do it,
there
or
will be
how I
recommendations
do it.
coming out of the report, and I plan on supporting them and supporting their implementation.
Sorry,
And the final point.
If you're
can we
using
feel confident that these
125x
weaknesses don't
leverage,
exist
you would
elsewhere,
have
given that
likely
they've
been
existed as
stopped
bank?
out. You would have been
These are
liquidated.
not weaknesses that are at all broadly.
Using
through the banking system.
25x
This was a
leverage.
bank that was an
How was
outlier
it?
in terms of both its percentage of
Wasn't even
uninsured
close to
deposits
being
and in
liquidated.
terms of its holdings of duration risk. And again, supervisors did get in there, and they were, as you know, obviously, they were on this issue, but nonetheless, this still happened, and so that's really the nature of the interview.
This is your
of the
daily
review,
range on
is
the
to
S&P
discover that.
500. Given what time it is, there is a
Michael
high
McKee from Bloomberg
probability
Radio and Television.
that your
You've
low
been very
is
consistent
in.
in saying that the Fed would be raising
There's
interest
a
rates
high
and then holding them
probability
there
this
for quite
is
some
the
time.
expansion.
Following today's decision,
Same
the markets
scenario
have
is
now
going
priced
to
in
be
one more
for
increase
this,
in
for
May,
me.
and then every meeting the rest of this year, they're
If it
pricing
comes
in
back
rate
down
cuts.
and stops me out, oh well.
Are they
I already
getting
made
this
money.
totally wrong from the Fed, or
That's
is there
all I
something
was
different
trying
about
to
the
do
way
anyways,
you're
right?
looking at it, given that you're
Make
now
a few
thinking that
bucks, get
moves
out.
might be appropriate as opposed to ongoing?
So we published an SEP today, as you will have seen, and it shows that basically participants expect relatively slow
scalping,
growth, a gradual
right?
rebalancing of supply and demand in the labor market.
Not
with
looking
inflation
for
moving
long-term
down gradually.
hodls from way up here.
In that most likely case, if that happens, participants don't see rate cuts this year. They just don't.
Just
I would just say,
looking
as
for an
always, the path of the
intraday
economy is
scalp.
uncertain, and policy is going to reflect what actually happens rather than what we write down in the SEP. But that's not our baseline expectation.
Well, if I could follow up and ask, as you look forward into the rest of the year here, are you saying that what you see and the 5.1% basically consensus is based on it will be sufficiently restrictive, or is it leavened by the idea of you don't know what's going to happen? In other words, what should people think about in terms of how the Fed thinks about how far it is from the terminal?
It's going to depend. Remember, we're looking, for purposes of our monetary policy tool, we're looking at what's happening among the banks and asking, is there going to be some tightening in credit conditions? And then we're thinking about that as effectively doing the same thing that rate hikes do. So in a way, that substitutes for rate hikes. So the key is we have to have policies got to be tight enough to bring inflation down to 2%
See the way the
over time. It
structure
doesn't all have to
looks
come from rate
currently.
hikes. It can come
It looks
from,
like it wants to
you know,
roll
from,
over.
tighter credit conditions.
Right.
So that we're looking at, and it's highly uncertain how
this
long
wick,
the situation will be
and then you
sustained. or
take
how
that wick
significant any
out,
of those
then you
effects
get
would
the
be. So we're just
impulse
gonna have to
leg
watch.
lower.
In the meantime,
Trade up to what?
know,
618
obviously,
retracement.
at the end of the day,
and then
we
you
will
get
do
more
enough
expansion.
to bring
So
inflation down to 2%.
there's
No
a
one should doubt that.
probability that it comes down and stops me out.
Hi, Chair Powell. Rachel
Especially
Siegel from
with the
Washington
news.
Post. Thank you for taking our questions.
On a normal news
I know
day,
we talked a bit
by
about how
2
Silicon Valley
o'clock,
Bank was
you're-
unique to a certain sector of the
there's
economy.
so much
But there's also growing concern that there are
probabilities that
financial stability
suggest
risks
that
from the
your
commercial
your
real
low
estate market
or
and
high
loans
is
that will begin
already
to roll
in.
over later this year
The
and next.
expansion is
And
up.
that smaller regional banks also disproportionately
You'd
hold
look for
those
that
loans.
to be the
Is there a risk
continuation
that
of
could
trade.
mimic the kind of what we saw with SVB to banks that disproportionately are focused in commercial real estate?
So, we've well aware of the concentrations people
The
have in
market
commercial real
don't
estate.
like
I really
one
don't think
single
it's comparable to
answer.
this.
You're gonna
The
get
bank- the
another
banking
spike
system
lower.
is strong, it is sound, it is resilient, it's well
In
capitalized.
fact, it's getting very close to
and,
stopping me out,
I really don't see that as at all analogous to this.
which is why I took
Question.
profits
Would you be open to an
twice
independent investigation separate from the Fed's
as it was
I
moving
welcome
up.
It's 100% certainty that there will be independent investigations and outside investigations and all that.
De-risk.
So we welcome, when a bank fails their investigations, and of course, we welcome that.
De-risk.
Thank you, Mr. Chairman. Edward Lawrence from Fox Business. Inflation has been rather sticky, so do you
This
need
is
help
the
from the
open of the
fiscal
day.
side to get inflation down faster?
Inflation has not been
We
rather
don't assume
sticky.
that. We don't give advice to
Dude,
the fiscal
it's
authorities. and
trending
we
lower.
assume that we take fiscal policy as it comes to our front door, stick it in our model along with a million other things, and we have responsibility for price stability. The Federal Reserve has responsibility for that, and nothing is going to change that. So we will get inflation down to 2% in time.
And if I could follow on that, but they're working, the spending that's happened is working against what you are doing, right? So it's prolonging inflation?
If you have to look at the impulse from spending, because spending was, of course, tremendously high during the pandemic, and then as the pandemic programs rolled off, spending actually came down. So the sort of fiscal impulse is actually not what's driving inflation right now. It was at the beginning perhaps part of what was driving inflation, but that's not really the story now.
Let's go to Neil Irwin.
Hi, Chair Powell. Neil Irwin with Axios. Two questions about aspects of the government's response on Silicon Valley Bank 2 weekends ago. First, why is this new bank funding facility done under Emergency 13.3 authority as opposed to expansion of the discount window, changing the terms of the discount window that's been around a long time? And second, can you discuss the Fed's role in the FDIC guarantee of uninsured depositors and why there's $143 billion on your balance sheet last week supporting that deposit guarantee?
Sure. So 13.3 seemed like the right, we have a little more flexibility under Section 13.3. We've done quite a lot under the discount window as well. We needed to do a special facility that was designed a certain way, so we did it under 13.3. Really no magic to that. It's only available in unusual and exigent circumstances, and it has to meet certain requirements, but it seemed to be the right place. So with the FDIC, we're lending to in effect, we're lending to the bridge bank. So that's where the funds came from, and it's a loan that's 100% guaranteed by the FDIC, so there's no risk in it for us.
Chris Rugaber.
Thank you, Chris Rugaber at Associated Press. The SEP suggests one more rate hike, as does the change in the language in the statement, in which suggests that you're perhaps nearing the end of a cycle of rate hikes. Do you feel, though, that if inflation remains high, you'll be able to resume additional hikes as needed, or have you somewhat tied your hands here with these signals about rate hikes coming to an end? Thank you.
No, absolutely not. No, if we need to raise rates higher, we will. I think for now, though, as I've mentioned, we see the likelihood of credit tightening. We know that can have an effect on the macroeconomy, on demand, on labor market, on inflation.
So there's your
and
pause.
We're going to be watching to see what that is. And we'll also be watching what's happening with inflation and in the labor market. So we'll be watching all those things. And of course, we will eventually get to tight enough policy to bring inflation down to 2%. We'll find ourselves at that place.
Coming close of saying that there's potential.
Hi, Chair Powell. Thanks for taking the question. Kyle Campbell with American Banker. I have a couple questions about the balance sheet. First of all, I'm curious at what point the financial supports that the Fed is extending through the discount window and through its enhanced lending facility might be at odds with the objective of reducing the balance sheet. And I'm also curious what your thoughts are on not just the availability of reserves, but the distribution of them throughout the banking system, and at what point you might be concerned about it being scarce for certain banks.
So people think of QE and QT in different ways. So let me be clear about how I'm thinking about these recent developments. So the recent liquidity provision that has increased the size of our balance sheet, but the intent and the effects of it are very different from from when we expand our balance sheet through purchases of longer-term securities. Large-scale purchases of long-term securities are really meant to alter the stance of policy by pushing up the price and down the rates, longer-term rates, which supports demand through channels we understand fairly well. The balance sheet expansion is really temporary lending to banks to meet those special liquidity demands created by the recent tensions. It's not intended to directly alter the stance of monetary policy. We do believe that it's working. It's having its intended effect of bolstering confidence in the banking system and thereby forestalling what might otherwise have been an abrupt and outsized tightening in financial conditions. So that's working. In terms of the distribution of reserves, we don't see ourselves as obviously running into reserve shortages. We think that our program of allowing our balance sheet to run off predictably and passively is working.
Because we're looking for a pullback.
Of course,
this thing is severely extended
to change that if that changes. But we don't see any evidence that that's changed.
And when I say pullback, I mean deeper than this.
Hi, Chair. Katerina Saraiva with Bloomberg News.
I mean, it's
The minutes of the
extended.
January-February meeting, the last meeting, indicate that you discussed the possibility of runs on non-bank financial institutions and the impact of large unrealized
Buying
losses on
support
bank portfolios.
around-
Can you talk a
hopefully
little bit
like
more
the
about that
Daily 21
discussion?
would be
Kind of what
ideal.
was talked about in light of that?
And the
And then why
weeks
didn't the
to
Fed,
come.
do anything about that at that point to ultimately prevent, what happened this month?
I mean, to be honest, I don't recall the specifics of that. It's been quite an interesting 7 weeks, but I will tell you though that there have been presentations about interest rate risk. I mean, it's been in all the newspapers. It's not a surprise that there are institutions that have had unhedged long positions in long duration securities that have lost value as longer term rates have gone up due to our rate increases. So that's not a surprise. I think, as you know, as it is now on the public record, the supervisory team was apparently very much engaged with the bank repeatedly and was escalating, but nonetheless what happened happened. And so that's really the purpose of one way to think about the review that Vice Chair Barr is conducting, is to try to understand how that happened and try to understand how we can do better and what policies we need to change. I mean, one thing is the speed of I'll come back to that, the speed of the run. It's very different from what we've seen in the past, and it does kind of suggest that there's a need for possible regulatory and supervisory changes, just because supervision and regulation need to keep up with what's happening in the world.
Can you confirm whether or not the board knew about these escalations by the examiners in San Francisco?
That's probably why the market's coming off.
I will have to come back to you on that. Yeah, I don't know.
Simon Urbanovich with The Economist. Thank you very much. Chair Powell, you've stated twice today that all depositors' savings in the banking system are safe. Are you saying that de facto deposit insurance covers all savings? Shouldn't Congress have a say in that? And just by way of example, if a bank with less than $1 billion in assets failed, are you promising to bail out all of its depositors? Thanks.
Well, I'm not saying anything more than I'm saying. So, but what I'm saying is you've seen that we have the tools to protect depositors when there's a threat of serious harm to the economy or to the financial system, and we're prepared to use those tools. And I think depositors should assume that their deposits are safe.
So stop taking your money out.
Thank you, Chair Powell. Greg
Your
Robb from
money's
Market Watch.
safe.
I was wondering if you could give us a little bit more color. You gave just a little bit of color. You said during the first week of the Silicon Valley weekend, you said the question you guys asked was, how did this happen when you saw Silicon Valley Bank? So I was wondering if you could go to the Credit Suisse merger. I mean, wasn't that the big gorilla in the room? Didn't you breathe a sigh of relief when that merger happened? Thanks.
Sure. So, that was really the Swiss government. We, of course, were following it over the course of the weekend, and we were engaged with their authorities in the way that you would expect, all the ways that you would expect. It seems to have been a positive outcome in the sense that the transaction was agreed to, and it has been the markets have accepted it, and it seems to have gone well. And I think there was a concern that it might not go well. So coming into the middle of this week, yes, I would say that has gone well so far.
Nicole.
Hi, thank you, Chair Powell. Nicole Goodkind with CNN Business. In the summary of economic projections, the FOMC sees the unemployment rate increasing to 4.5% this year. I'm wondering how you anticipate preventing this from snowballing while using the admittedly blunt tools at your disposal.
So that's an estimate of what will happen as demand slows and as conditions soften in the labor market. And it's a highly uncertain estimate. And I mean, there's really, we have to bring inflation down to 2%. The costs of bringing it down, there are real costs to bring it down to 2%, but the costs of failing are much higher. And if you read your history, as I'm sure you have, you can see that if the central bank doesn't get inflation back in place, make sure that inflation expectations remain anchored, you can have a long series of years where inflation is high and volatile, and it's hard to invest capital. It's hard for an economy to perform well, and we're looking to avoid that, and and to get back to where we need to be, back to where we were for a quarter century, and get there as quickly as we can.
But I guess the question is, historically, it's hard to.
Mr. Mike, please.
He answered your question.
Historically, it's been hard to contain unemployment, and the question is, do you worry about some sort of snowball effect, and how do you factor
He
that
said
into
yes.
your projections?
He said it's an estimate.
It depends on whether so recessions tend to be nonlinear, and so they're very hard to model. The models all work in a kind of linear way. If you have more of this, you get more of that. But when a recession happens, the reactions tend to be nonlinear, and that's so we don't know whether that'll happen this time. We don't know. If so, we don't know how significant it will be. And so, we're very focused on getting inflation down, because we know in the longer run that is the thing that will most benefit the people we serve. That's how we can have a long, we've had very strong labor markets through these long expansions that we've had. 4 of the 5 longest, or 3 of the 4 longest expansions in U.S. history have been really since the high inflation period. And the reason was inflation wasn't forcing the central bank to come in and stop an incipient or an expansion. You can have very, very long expansions without high inflation, and we had several of those, and they're very good for people. You see late in an expansion, you see low unemployment, you see the benefits of wages going to people at the lower end of the wage spectrum. It's just a place that we should try to get back to.
Jean?
Hi, Chair Powell. Jean Young with Market News. I just wanted to ask, with all the events of the past 2 weeks, do you still see a possibility of a soft landing for the U.S. economy?
It's too early to say really whether these events have had much of an effect. It's hard for me to see how they would have helped the possibility, but I guess I would just say it's too early to say whether there really have been changes in that.
It came off
The
quite
question
a
will be
bit,
how long this
so
period is sustained. The longer it's sustained, then the
hopefully
greater
you
will
guys
be
took profit on that move up and moved your
likely
stops. Because that's
declines in
always
or
the
tightening
goal
credit
when we do
standards,
these things.
credit availability.
Just
So
to
we'll just
make
have to
a
see. I
few
do still
dollars
think, though,
and
that
get out.
there's a pathway to
Because
that.
the
I think that pathway still
volatility
exists,
is
and,
moving.
We're certainly trying to find it.
We're not trying to pick market direction.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. Just wondering how many financial institutions have been issued matters requiring attention or matters requiring immediate attention citations at this point?
How many? I don't know. But those are serious. Those are serious regulatory, particularly immediate attention. And I guess there were 6 of them. So.
And getting to the seriousness of it, how are you going to ensure that banks comply with these citations, take them seriously? How will you enforce them?
That is a great question and is right in the heart of what the review will be doing under Vice Chair Barr's leadership. So I think that's what you think about. What can we do to make sure? But again, that's not for me to answer today.
So you don't have specific thoughts on that?
Well, if I did, I wouldn't share them because I really, this review is going on, and I want nothing other than us to find out what happened and why, figure out what we can do to do better, and then implement those changes. That's all I want. It's for me to be giving you my half-formed or partially informed thoughts. It just isn't appropriate. There's a real serious review going on with people from all over the Federal Reserve System who are not connected to this, to this work, not connected to this bank, and under again Vice Chair Barr's leadership, and I'm confident that it will produce a satisfactory result.
Okay, we'll go to Jennifer for the last question.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. Curious, how do you view financial conditions right now? If credit becomes expensive enough, choking off growth, as you said you're watching for, would that situation warrant a rate cut? What situation would warrant a rate cut? And have the bank failures prompted any discussion around changing the implementation of the balance sheet runoff? Thank you.
So we haven't really talked about changing the balance sheet implementation. That's not something we've discussed yet. As I mentioned, we're always willing to change that if we conclude that it's appropriate, but we're really not seeing any signs there. Sorry, then the question before that was, just give me a,
Curious how you view financial conditions now, and if
Yeah,
credit were
okay.
to tighten enough, if that would prompt a rate cut.
So, financial conditions seem to have tightened, and probably by more than the traditional indexes say, because the traditional indexes are focused a lot on rates and equities, and they don't necessarily capture lending conditions. So we think that, though. So there are other measures which if they're focused on, bank lending conditions and things like that, they show some more tightening. The question for us, though, is how significant will that be, and how, what will be the extent of it, and what will be the duration of it? And then, once you know that, there's a fair amount of research about how that with broad uncertainty bands, how that works its way into the economy over what period of time. And so, so we'll be looking to see the first part of that, like how serious is this, and how does it look like it's going to be sustained? And if it is, it could easily have a significant macroeconomic effect, and we would factor that into our policy decisions. I mentioned with rate cuts, rate cuts are not in our base case, so that's all I have to say. So,
Thank you.
thank you very much.
Rate cuts are not within our base case. Not yet. So basically, the market isn't reacting as negatively as it should be, is basically what he's saying, but it's because the markets are capital inflow driven, right? Capital flows into these markets and out of these markets. It's rotating continuously. It does. They don't really factor lending, right? The markets, Bitcoin doesn't give a shit if the U.S. government's lending or not. I mean, banks or whatnot. Banks do, right? Banks care. We know that. I mean, they got crushed. Some of them are dead. Some of them are never coming back, right? But the majority of them will be fine. You can clearly see that there is support building in some of these things. There was bad news on PacWest this morning. It was gapping down a little bit, but they literally were making it sound much worse than it was, because here's the previous day, and then there's where your gap was. So, like, they were literally making it seem like it was gapping off the face of planet Earth when it wasn't, in fact, gapping low at all. And then a big part of today, you traded inside of yesterday's range. This one's down 22%. This one is the one that's dead, I think. Or one of them that's dead. Yeah, that one's dead. This one's dead. You see, that's Friday, March 10th. We're in the 22nd of March. That thing's done. But your banks they did get hit. They did get hit hard. And some of them are still, yeah. Some of them are still getting pounded. But naturally, short sellers are smart, guys. They do their homework. They sniffed out the problem. They realized real quick that most of these banks that they were looking at, SI, SIVB, and SPNY, all of them were completely over leveraged, long duration. So they hit them hard. That's the free market. Generally in America, we used to let them fail. But essentially, all they're trying to do is protect you, the actual depositee, your money. They don't care about the stockholders. Like, if you own shares of this company, you are not getting your money back. That money's gone. But if you deposited money into an account here, say $500,000, you're going to get that $500,000 back. That's basically all that's going on, right? The market will take it however the market takes it. It usually takes a couple days for the market to digest this news. Also, we expect a choppy sideways market, guys. We have for a long time. 2023. I had so many videos where I discussed, your prior ranges, what you can look for, the areas where you want to be looking for positions, where you don't want to be looking for positions. In Bitcoin's case, it's just such a massive move to the upside because you had so much retail that looks at bullshit charts and got short down in here. Right? Because why not? Why not? Why not? Why not short at Bitcoin at 16K when it literally just came up, spent a whole year dropping 75 to 80%? Let's short the lows. So they got caught on their back feet. They got squeezed. FTX was the final nail in the hammer. Or the final nail. Right there. Pounded. That's what caused the massive liquidation that we needed to see. It's also what caused the majority of people that hadn't capitulated yet to capitulate. We've seen this in on-chain data. That's why we were buyers. We've been long or looking for longs since back over a year. We assumed this would be the low. And had FTX not happened, it would have been more than likely. Because look where you're trading now. All right? Look where you're trading now. So the easiest way to determine or dictate where you're looking for price to go is by looking at your higher time frame candlesticks. They show you, right, where massive supports and where massive resistances are. This is a big, fat, engulfing candle. So next month, you can spend the entire month pulling back. Where can it go to? It can go all the way to there. This is your range. So in a sense, getting rid of all this, this is the range that you could potentially trade in for 2023. $46,000 to $16,000. Will it? I don't know. It's got a big level of resistance coming up. A lot of people are looking to short that, obviously. It is a yearly Heath level. It is supply. Right? is supply. So it's only natural that on the first attempt, you're going to find resistance. Look at last week's candle. We can spend 5 weeks trading lower. We don't know where the pullback will be, but we have tools that we can use that will guide our hands, our decisions, if you will. Right? This one being the main one. As long as we're not opening and closing weekly candles under this yellow line, you are still trending up, and you do need to be looking to be a buyer at support. Support can be old resistance areas or flat out support. You can pull back as far as there and be looking to be a buyer there. Absolutely. Absolutely. If you want to go out further, there's your 2-week range. Notice how this candle traded inside of this candle's range. See that? So your high probable short was where? Yep. There. Right there. This candle, where would you have been wanting to get long? There. Why? Well, because you took out that low. And then what happened? Price traded all the way back up to the top end of the range. There. Then what happened? Well, shit got a little bit more volatile, didn't it? You pulled back, closed. Now look where you are. This isn't an expansion candle. This is a consolidation candle. This is a classic bull flag. Right here. If you are a bear, you should have stopped being one here. Why? Because you had a 2-week candle break out and close well above where the shorts were setting. Clearly, this candle clearly showed you directional trend change. If you do not know how to identify that, that is, you need to subscribe to my channel and go through my videos, as that is what I teach. I teach people how to identify trend, how to identify high probable areas to look for trade entries, how to analyze candlesticks, price action. But you can clearly see. So now that you've had a breakout and an expansion, this is the new freaking range. Well, let's just get a new one. Screw it. Right there. And it can take 6 weeks before it finds support. 8 weeks before it finds support. If it finds support. Will it find support? Yeah. Probably. Yeah. It's going to find support somewhere. And then you're going to be targeting right back up to the top end of the range. Longer term, though, for all of 2023, you could potentially have a range this big. That's how price action works. If you don't believe me, look right here. Expansion phase. That's a year of expansion. One whole year of expansion. Here is resistance. You traded up. Didn't take out that, but I'm sure you took out some weekly highs before you ultimately rolled over and then had your bearish expansion. But you stayed within this expansion here. Even the very next year, you stayed inside this expansion. Like perfectly. This price is what got the term Heath level even coined inside the CTM. And all it is resistance. It's not actually even a Heath level. It is simply monthly, quarterly, and yearly resistance. That is how I knew to look for shorts there. And then this is how I knew to look to be a buyer around 36.91. You see this right here? This is how I knew to look to be a buyer here. So I'm sitting in longs from 16,540. That is the yearly opening range. All right. So I'm going to go ahead and say that that's a good enough, decent test for yearly supply. So we could potentially see a pullback all the way down to there for the rest of at least Q2, Q3, maybe even Q4, who knows? But the potential range is all the way up to there. Unfortunately, that's how price works. That's how markets work. It's not my rules. I didn't invent them. Traders did. Traders do. Candles are sentiment driven. It just shows you what other people are thinking, what they're doing. The higher the time frame, the better the zone. So yeah, you could see price trade inside all the way down to the low, all the way to the high. The S&P 500 could trade inside of this for all of this year. All of it. And although, there's going to be many trading opportunities in every single, not every single price point inside of this candle, there will be many opportunities inside of this candle. But the main opportunities are there. and there. Those are the main opportunities. So if you get under 38.45, you can be a bear again. I don't know that you're going to see downside continuation, and I don't know that you're going to come all the way down there and take that out. It's impossible for me to know that. But I do know if you get under this, you could be a bear again. Yeah, you can. I would be. If we get under the $16,530 area, I will be bearish again. Hell yeah. There's a target right there that did not get hit. Right there. And we know that the market loves to liquidate. We know it does. And the places that it liquidates are wick highs. But that's on a broad spectrum. That's like on a massive. Most people inside of this room, they do not have the patience for that. They do not have the patience for that. They want to know what I'm thinking in every single one of these candlesticks on this page. You see what I'm saying? Like, they think all of these candlesticks mean something. They don't. They really don't. There's only a few that mean anything. Right? That's an important area. That's an important area. Here's an important area. There's an important area. Then you got an expansion. Oh, there's going to be a big drop potentially if you start closing under this low dailies and then don't reverse. So what I mean is if you trade all the way down to this low and then close, then we'll probably be looking for continuation. Or is that a trap? Those are the questions we're going to ask ourselves once we take out that low. If we take out that low, this thing could trade sideways inside of this expansion range here for a long time. So we know that it's extended and we are looking to be buyers, but I would have much rather that thing traded up to that one price so I could have got short up there. That obviously was going to be a better trade simply because there's nothing else up there. Like nothing. And we went over all that stuff. It would have been specifically looking for the pullback. Trying to get short for the pullback. But the trade itself, to be on the right side of the market, in my opinion, is to wait and be a buyer. Be a buyer. There or there. Depending on how long it takes it to get there and how long it takes this to get up into there, could be not long. But if the market's waiting on this one, or if you start closing dailies under this, then we know that the market is more than less probably looking to come back down there. Right? And then we can look for those lower areas to be still a buyer because your trend is different. It's over with. What happened in 2022, I'm paying taxes on all that stuff. So that is all over and done with. Over and done with. This no longer matters. This no longer matters. No matter how you draw it, it no longer matters. All of this does not matter. I'm paying taxes on it. It's over with. We still have 3 quarters, though, of 2023 that will provide opportunities. They will provide opportunities. And we will catch them. Or try to. We will fail occasionally, but not always. We catch more than we fail at. Because we know what we're looking for. We understand that as of the first of the year, you have a new trend. And that's trend trading 101. That was taught on the very first day of free free markets. Trading, free markets. 101. Everything works on time. Yearly, monthly, quarterlies. That's why you get an annual report, a quarterly report, a monthly report. Depending on how bad you are, your PO might want a weekly report. But everything works on time. We live in a 60-40 world, guys. You can assume you're wrong 60% of the time. And still make money. We're not trying to anticipate market direction. We let the market tell us the direction. We find the range. Then we operate on the outer boundaries of those ranges. That's where you find us. That's where you find us. That's where you find the high probabilistic trade entries, the trade ideas, if you will. The time of day, where to look, all that stuff is taught freely on this channel. All of it. Would I be a buyer on this today? No. Why not? Well, because I'm expecting a pullback. I am expecting a pullback. Like every one of the higher time frames, man, they need to cool off a bit. RSI, you're in oversold territory. If you look at mean reversion, which you have to look at mean reversion. It's part of price action. Price oscillates back and forth. It doesn't just go straight up and straight down. We know this. It makes ranges and it comes back and retests those ranges for support or supply and demand. You can clearly see that you are on the outer bounds. Looking to be a buyer up there is almost suicidal. But you can't just randomly short it either. You need a reason to short it. And it can't just be because it's up there. There has to be a price, a specific price to short. A big one, preferably a higher time frame level, whether it's a liquidation point or just a straight up resistance or support, as that gives you a target, that gives you something to aim for, to place your entry, and then time will tell you if you're right or not. I've just been able to hone it and sharpen that edge to where I can do it almost every single day, but not on big news events. Like, because usually price action is all janky and like, look at the last 4 days. You've done nothing essentially. How many trades did you take starting from Sunday to today? You don't have to answer that question in the chat because there's still 72 people in here. But just answer it to yourself. How many trades did you take Sunday to today? And then go back, create a spreadsheet, and see where you took those trades. Then ask yourself, why did you take those trades? And did you make money on any of them? If not, stay tuned. I will teach you. I will teach you. You will get better. It's a promise. Will I be able to make you a successful day trader? No. But can I teach you what to look for when you're looking at a price chart? Where the higher opportunities are, the higher probable opportunities? You're damn right I can. I mean, how close did we come to that target before price rolled over? Now on Bitget, it was much further away. On Bitget, you didn't even get close to that same level, that monthly resistance. There it is right there. You didn't even get close to it. So you did get close to it on Coinbase, and that's good enough for me. I would have taken the short had it hit that level. I had a limit order at the price. It's just, it is what it is. It is what it is. We didn't get it. That's okay. There's no need to cry if you missed this short. And there's no need to unsubscribe if you missed today's short or today's long. Because if you're going to get downside continuation and you're going to test deeper into the range, have no fear. Heath is here. There are 2 places to watch for entries. They are right there. 28,207 spot 33 and 27,823 spot 32. Either one of these areas on a retest showing you intraday that it is in fact resistance. You can look for short entries. But make damn sure you're not looking for a $14,000 target off of an entry there, because you won't get it. And it ain't going to happen in a day. You will be looking for a 2-to-1 risk to reward. There is an opportunity given in each single one of these daily candles. There is an opportunity. And it is getting easier and easier for people to find them. I see it in the Discord all of the time. Yeah, we do tomorrow have the Swiss franc SNB, that's the Swiss National Bank. They're going to do a rate decision as well. And we are looking at this to be risk off because we are looking as the markets to be risk on. The reason we're looking for the markets to be risk on is because it's a new year. Also, the dollar has set a clear and obvious range. This was the 2023 high. Now this is your 2023 low. So you are range bound. Now you are range bound. Look at this. Where did you reverse today? Today, like just a second ago. It's not freaking rocket science, guys. It's not. You all watch people that don't know what they're doing, and you've been taught wrong stuff that doesn't even matter. The marketplace does not care about head and shoulders, cup and handles, rising and descending wedges, and all that crap. It does not. It cares about order flow. And professional traders know this. Why did it bounce here? Did Heath invent that? Nope. All I did was discovered it years ago. I seen it happening over and over and over and over again. This is either a place to be a buyer. This is only a place to be a buyer. Whether you are looking for fresh longs or if you are exiting fresh shorts, this is where you are going to do it. Because that's the bottom of the range. That is support. Look at last month. We liquidated January's low, and we liquidated this low as well. The next liquidation point on the dollar is all the way down here. So we pretty much knew that we were exhausted here, and then that we were going to be looking for a run above. So we were looking for shorts around here. Guess what? That trade did not work. Right? It did not work. So the next area to look for trades was where? Here. Why? Well, that's the range of January. Boom. You liquidated January's high. You also liquidated December's high. Now you're rotating right back down to the downside. So now you are no longer in a trending environment. Now you are in a range-bound environment. You will only be trending once you take out this or this. So for now, you have to wait. Does price start to trend on a daily basis under 102.089? Well, if it does, then we can look to sell rips into this area, right? Because we have a potential trend working in our favor. But as of right now, we're range bound. We did have a trend. We were in a downtrend, but then we made a new uptrend. But now we're back to making a downtrend. What is that called? That's called intra-range bound price action, or AKA chop. Chop. So we got to get our yearly pulled back up here, because this is your yearly opening range. Technically, this tick is the yearly opening range, but it's just a tick on this chart. It's one tick. I do not know why you got one tick on Monday, January the 2nd, but you did. So technically, that's your yearly opening right there. I just used this because it had structure to it. It's got body to it. Like a woman's hair. It's got body, right? Once we broke down, I was bearish the dollar, looking to sell rallies into resistance levels. It's once we started taking out the highs that we had to wait. And we had to wait for it to get up here, as that was the next area to look to be a seller. And multiple days, it looked like it was going to work until boom. That got us right there. I took it long on Euro USD. That position was stopped out. That's to be expected, as the market is testing the range. So now you're looking to be a buyer of pullbacks, right? Until you get back here and break down again. So you can see where you're looking for your operations, where you're looking to be a trader at. So on the near term, because make no mistake, the daily time frame, even though people that constantly look at the 1 minute and 5 minute chart will never even look at a daily chart, on the near term, you are bearish and you will be looking to sell rallies on the dollar until you get back above 103.663 or above the daily 21 or above the 50 on the RSI. Those are the rules of the strategy. If price is trending under the 50, then we look for bearish entries as the bears are in control of price. Price is above the 50, we look for those bullish entries. And usually you can see that you're going to have correlation with the 21 exponential whenever you come into contact with this 50 area. That's why I use above the 50s bullish, below the 50s bearish. Because usually you're going to be right at this. And this is a pretty decent little indicator for as long as you have correlation with an actual resistance point to look for short entries, right? You could have looked for short entries there as well, as it is resistance, and it failed for 3 days, but you were still kind of stretched out away from that. So you have to understand that price could be looking for that. And if we go back over to the CAD Swiss trade, look, it took out resistance. But it stopped where? At the 21. We do not take positions based on the 21 or based on the 50. We must have some kind of price to line that trade up with. An objective price. If there isn't one, look to the higher time frames. There wasn't one. So it's just a trap. What do we do when we get a trap and a confirmation of a trap? We revert back to the original resistance. So any pullbacks back into this area will be looked at as a selling opportunity. 67769. So tomorrow, if you do get a big bullish rally up to here, as long as it stops, you can look to sell it. Because you are, in fact, trending lower. And where is the Aussie Swiss? This is the other one. It pretty much did the exact same thing. Kind of screwed us here. Gave one big bullish day. That's why I say patience. When you think that you're being patient enough, you probably still are not being patient enough. You did close above resistance on this day here. So that would have told you to chill on any bearish entries. Then once you got up here, major close, then you could potentially look to short there. But beware, because you will get shit like that. All right? But you would have known you were right pretty quick, because that's a 1 hour candle. So within 1 hour, if you shorted at 0.62436, if your stop was wide enough and you did not get stopped out on that push higher, you knew you were pretty much good. Or you could assume you were pretty much good. Right? Watch your daily opens, your daily closes. Line that up with a trending indicator being the 21 exponential. Don't worry about the 21 on any other time frame. Dailies, weeklies, that's it. Don't worry about the RSI on any other time frame. Daily, weekly, that's it. Because we're trying to nail the best trades. We're trying to nail those trades that you can sit in for a while and generate alpha as price slowly moves away from your entry. This trade is looking more and more like it's, good to go. Right? We're short this. I'm short this up here. I was looking for a pullback. There's the pullback. I wanted it to find resistance up here, knowing that it can take a few weeks. I patiently waited, and then boom. That looks good to me. Now all I need to see is another one of these right through that, right in there, and that will look really good. And then once we start to take out this stuff here, then this leg of expansion has a measured move on it down into here. Resistance is right there. It's still not easy because the market plays games, but you will get it. I will do my best to teach you. You will obviously have a lot of work to do on your end. You can't be over trading. You can't be assuming that every hourly close is support or resistance. It's only certain times of the day that we're looking for entries. The Asian, London, or New York sessions, as that's when the big volume comes in, or around a massive news event like we just got. But Bitcoin is still super bullish. Super bullish. People are going to be looking for that to hold support, and it could. But I think you're going to see a deeper correction, as it's been bullish for a long time. This was a deeper correction. This is a correction that I wanted to see. Unfortunately, it got a little bit deeper than I expected it to get. But once we got back above that, we were golden. It's just different on the daily. So the overall trend is still intact. So there's no point for me to close this long position down here. None. Even though this thing's pulling back, there's no point in closing it, because trying to nail that perfect second entry for another leg up, it could be impossible or even futile, because I know that, we could be seeing a deeper correction. So obviously 21,775 is going to be very important price. We don't want to see no 2-week closures under that, as that could mean that we're coming back down to liquidate that, and then even potentially coming back down to grab that. I don't think it will. I think you'll find support. There's only 4 days left on this candle, so I'm not expecting a massive drop, but the overall trend's still bullish. You're still bullish. We're going to wait for the pullback, and we're going to be buyers, and I'm going to be looking at the charts every single day, like I do every single day, trying to nail that beautiful entry, that big, beautiful, bullish trade, so we can watch this thing reach for the stars again. And who knows, maybe eventually we go up there and we get that other gap. Since everybody's so concerned about gaps. But you do have one down there. You do have one down there. I would be more convinced, though. I mean, looking at the structure that is on the chart right here, to me, it looks more like this thing will find support and aim for this gap, then probably spend several months or several weeks pulling back to this gap. So if you didn't get a chance to buy 20K, you still might. You still might get a chance to buy 20K. That's what I'm saying. Like, don't think that you missed anything. You haven't missed anything yet. These ranges are big. That's a big ass range. I don't think you'll ever see this gap fill, but that's just personal opinion. So now you got 2 gaps left on the chart. And then any new gaps that get made from, now until these gaps fill. But it's not going to be an easy year for trend traders. It's going to be an easier year for traders. This is a trader's market. This is a trader's market. So we're going to be fine. It's much easier to trade when you're in a trending environment. Obviously, you just get long and buy every freaking dip, especially when you're parabolic. Just buy every dip. But you're not in that environment yet. And we probably won't be until the Fed gets their 2% target. If the Fed can even get their 2% target. I don't know that it's mathematically possible for them to get to that 2% target. But we'll see moving on in the future. It won't matter to us because we have an edge. A very, very sharp edge for extracting profits out of the market. Yeah, you can definitely run the speed up higher. I speak slowly because I have no reason to get in a hurry. I've always been laid back and chill. And like I said, my voice is lagged up real bad right now. Because something's going on. Not sure what it is, but hopefully it clears itself up because it's so annoying. But we'll catch the pullback and we'll get long. Let me just make sure that I don't miss anything. Yeah, everybody that's asking about the Patreon, man, it's in the description. I hate talking about it, but it's in there. Just click on more and you can find my Twitter follow. You can find everything you need. For the person that said Patreon is illegal in their country, send me an email. We'll work something out. All right. Confluence of support, 26, 9, 14 days support, and trendline support. Yeah. I don't know what trendline support you were looking at, but I mean, it would be very parabolic. I don't think I would use it. I mean, even just like something like that. I don't know. Nah, I'm looking for a deeper pullback than that, dude. I want to see at least a 618 retest of this week's candle. This is a massive range expansion breakout. So, I mean, it may find support here. It very well could. Because it is a massive breakout expansion. And those typically don't provide deep pullbacks. Just be aware that on the closure tonight, during the Asian session, you might have a dip below that low. Or during the London session, you might make a fresh daily low and then bounce and still maintain that support. But these are definitely the next two areas to look for support, for sure. And it would still be in line with this massive move, because this isn't just this green candle's this is expansion. From here to there is the expansion. You see that? Because you got a reversal once that wick was put in down there, and it was just 2 weeks up. Three weeks it took. There it is. There's your 3-week expansion. %50 retrace of this candle. Boom, up. That's 2 legs though, so technically that's a double play. That's a measured move even. Measured move. You had 6 weeks of nothing, then you retested the 50% retrace, and then you got your expansion. So you could get another couple weeks of moving sideways to lower, or that bullish momentum can continue. We will see one way or the other. These are the next areas to look for, though. If you close a daily under either one of its low down here, then you're going to be waiting for this area to be support. But yeah, it definitely would have been nice to catch that short. You guys know that we were looking for that in the Discord. That's where we wanted to see it get to. I wrote that at like 11 o'clock this morning. If we could get up to that, that would be a good spot to look for short entries. It just didn't quite get there. Not enough for me to take the entry. But it could have for you. It could have been a good spot for you. Maybe you did get it. If you did, kudos. And occasionally, like I said, if you think it is going to be a liquidation break, you know how to play those as well. Wait for price to get back under it and then hit it home. You would have been stopped out initially because you had 2 5-minute pushes and then a second deeper push. But ultimately, you don't have to risk just that wick. You can risk higher. There's a big figure number right there in $29,000. You could have put your risk up there and then taken a short entry there upon re-entry of the liquidation high. Find a big figure number, throw your stop above it, see how that works out. I mean, obviously I told you you're going to liquidate the highs of day. Then you're probably going to be looking for a liquidation of the longs. We discussed all of that yesterday because we had already liquidated shorts. So the market was probably going to start looking for longs to liquidate. All right. Come down and look for the long liquidations. I wish this thing gave me more data. Oh, that's gotta be why. Yeah, that's why. There we go. So you just ran out of longs to liquidate. So the market reverses and goes to get the shorts. Boom, boom, boom. 3 drive topping formation. Your liquidations are getting less and less on each push higher. So it makes sense for the look for the pullback. And we were also seeing open interest get bigger. That means longs were getting extended. That's why we wanted it up there, but it just didn't get up there for us. It's all good. We'll catch the long. Most people are wanting the long anyways. All right, you guys have a fantastic rest of your day. If I missed your question, just drop it down in the questions below, comment section below, as I read them all and answer them all. Thank you all for your time. You guys have a fantastic day. Until next time, make sure you guys trade safe, trade smart, and as always, happy trading, everybody.